This is the summary of The Intelligent Investor by Benjamin Graham. Introduction. What does it mean to be an intelligent investor? Do you need a high IQ in order to make returns? Benjamin Graham says no. An intelligent investor is the one who has discipline, patience, and eagerness to learn. It means being able to control your emotions and think independently. Graham emphasized that this kind of intelligence focuses more on the character than the brain. Did you know that Sir Isaac Newton once invested in stocks? It was in the South Sea Company, which was the hottest stock in the UK at the time. Newton felt that there was panic in the stock market. That is why he sold all his stocks. He gained 100% profit at 7,000 euros. However, a few months later, Newton was driven by the enthusiasm of people. He invested again in South Sea Company at a much higher amount. The result is that Newton lost 20,000 euros. Later, he remarked that he is good at calculating on heavenly bodies but never on the impulses of people. Newton asked his friends not to mention the words South Sea to him ever again. Was Newton disciplined, patient, and eager to learn? He is certainly at physics, but not with investments. He was not able to control his emotions and was influenced by the opinions of others. That makes Newton an intelligent scientist, but not an intelligent investor. The world of stock trading used to be like a medieval guild. Investors work around in guesswork and superstition. It was Benjamin Graham who changed all of that. Through his book, he set structure and clarity into investing that it became a modern profession. How did Benjamin Graham become an authority in investments? How did he gain so much wisdom in stock markets? Benjamin was born to a rich family in London in the year 1894. His father was a dealer of Chinese porcelain. When Benjamin was 1 year old, his family migrated to New York. They had a huge house with several servants in the Fifth Avenue. However, Benjamin's father died a few years later. They lost the porcelain business and became poor. What Benjamin's mother did was to accept some boarders into their house. She also invested some of their money in stocks. Unfortunately, she lost everything in a stock market crash. Benjamin had one embarrassing story of going to the bank to cash out a check for his mother. He heard the bank teller confirm if Benjamin's mother is good for $5. This event motivated him to work hard and improve their situation. He gained a college scholarship. Benjamin graduated at the top of his class. He was only 20 years old at the time, but he was already offered to teach by 3 different departments. However, Benjamin had to decline. He had his eyes focused on the Wall Street. He began his financial career as a clerk. Then he became an analyst and after that a partner. Soon, Benjamin built his own investment company, which was called Graham Newman Corp. For 20 years, his investment firm gained 14.7% returns annually. There became a great crash in 1929 to 1932, but Graham endured and even prospered afterwards. His firm is one of the most successful in the Wall Street. How did he do it? How did Graham thrive in his long investment career? In this book, you will learn practical tips on how to be an intelligent investor. You will learn how to minimize risks and choose your stocks among others. The Intelligent Investor was first published in 1973. But Benjamin Graham's teachings are so essential and insightful that the book remains very relevant today. The business magnate Warren Buffett says that Intelligent Investor is the best book on investment ever written. The business magnate Warren Buffett says that Intelligent Investor is the best book on investing ever written. Investment versus speculation. Do you know why brokers in the New York Stock Exchange always cheer when the bell rings at the end of the day? That is because, regardless if you win or lose, they will make money. You should know the difference between an investor and a speculator. There are many speculators in the stock market. You shouldn't make the mistake of being one of them. Speculators are just like gamblers in a sense. Gamblers bet huge amounts of money on high risks. They win sometimes, but lose most of the time. All the while, it is the casino which is benefiting. How do you know if you're investing and not speculating? It is when you study the company first, when you weigh its pros and cons before buying stocks. Second, it is when you avoid taking high risks. And third, It is when you expect adequate and not overly high returns. If you keep in mind these 3 rules, you will avoid losing money on your investments. You will gain money for yourself and not for the brokers. Speculators are prone to making wrong decisions. Investors, meanwhile, are always cautious. The result is that they have long-term sustainable success. You will become one if you follow Graham's guidelines. Now more and more people are getting into day trading and online trading. It became more like playing a financial video game. Information about investments is pouring out in bars, kitchens, cafes, and restaurants. Financial advertisements are all over TV and internet. The problem is that people are misinformed. They are getting plenty of data, but not enough intelligence. They just see stocks as blips on the screen. Most of them are speculators. They don't bother to learn about the companies they invest in. What is important for them is to know the ticker symbol so that they could buy the stocks. In 1998, the stock price of a small building maintenance company tripled in just a matter of minutes. The company's name is Temco Services. The reason why its price shot up because people confused its ticker symbol TMCO with TMCS. Ticketmaster Online is a popular website which just had its IPO. People invested in Temco Services because they thought it was Ticketmaster Online. They didn't bother to take 2 minutes to check the ticker symbol on the internet. They just bought stocks and ended up buying Temco instead of TMCS they wanted. Would you be comfortable not checking stock prices every day? According to Graham, that is one criterion to be an investor. You should be looking at the long term, at the values of company you invested in, and not the everyday fluctuation. Doing so will prevent you from being influenced by others. There was one analyst in CIBC who pegged the price target of Amazon.com to grow from $150 to $400. The result is that Amazon stocks increased 14% on that day. That was in 1998. The analyst Henry Blodgett explained that his price target is pegged on a span of 1 year. Nevertheless, Amazon stocks continue to increase. It even exceeded $400 in the next few weeks. A century of stock market history. In the 1900s, a group of stock market forecasters said that since 1802, stocks had an average of 7% returns every year. It means that investors in the 1990s can rely on at least 7% annual returns. The forecasters base their future predictions with full trust on the past. However, for Graham, this is just beyond logic and reason. The author is always equipped with practicality and common sense. He argued that past behavior of stock market can never be the same in the future. Indeed, the forecasters were proven terribly wrong. Kevin Landis, a manager of first-hand mutual funds, did an interview for CNN in 1999. He was asked if stocks on wireless telecommunication were overvalued. Landis replied that it is not. The industry is growing and it will continue to do so in the following years. Robert Froelich, a strategist at Kemper Funds, appeared in the Wall Street Journal in 2000. He implied that people should not be scared to invest in companies with high stock prices. According to Froelich, these companies have the right vision and right people. It should be worth it to invest highly in them. Jeffrey Applegate, a strategist at Lehman Brothers, was featured in Business Week in 2000. He said that just because the stock market prices are higher doesn't mean that investment is riskier. But the truth is that it is indeed riskier. Investing in stocks is always risky, whether in the past, in present, or in future. These 3 forecasters who believed that there is guaranteed high returns in the 1990s were ultimately crushed. Landis lost 67% of his stocks on Nokia and 99% in Winstar Communications. Froelich lost 70% on both Cisco and Motorola. In total, Cisco investors lost $400 billion. When Applegate made his assumption in 2000, Dow Jones Index was around 11,000 while Nasdaq was at 4,400. After 2 years though, the situation changed completely. Dow Jones went out to 8,000 and Nasdaq fell to 1,300. The lesson is that the higher you assume on returns, the harder you will fall. The intelligent investor will not invest in high-priced stocks even if forecasters are optimistic. There is always a limit to profit that companies can gain. And so there must be a limit to the amount that investors are willing to put in. High-priced stocks can be compared to Michael Jordan, who is the all-time basketball superstar. When the Chicago Bulls drafted him, the team acquired so many supporters and admirers. Chicago Bulls paid Michael Jordan $34 million every year that he played with the team. No matter how great Michael Jordan is, it would not have been sensible for Bulls to pay him $340 million every year, or $3.4 billion, or even $34 billion. That is just ridiculous. Likewise, investors should not be so carefree on putting in their money. Remember that past cannot predict the future of stock market, and there is always a limit to the returns that you can get. Graham suggests a simple rule to any investor: buy low and sell high. The problem is that the majority of people do the opposite. They end up buying high and selling low. The next time you hear an expert give a very optimistic forecast, remember the rule of opposites. The more optimistic an investor is for the long term, the more likely he will be proven wrong in the short term.